Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge and number 77, all about family trusts. Before we kick it off, there's the disclaimer: facts, figures, information only, it's not advice. So, what is a family trust? It's effectively just an agreement where a person or a company agrees to hold assets for other people, meaning that this group of people have got together and effectively we're trying to look at our assets as a combined investment. And then we're going to distribute from that trust to the people in the trust in whatever we like to do. So, generally speaking, set up by a family to own the combined assets. So it could be mum and dad, children, could be brothers and sisters, and so forth. It could be extended family, but generally speaking, it's the family unit can set this up. A family trust is also known as a discretionary trust, and the reason for that is that that's exactly what this is all about. The trustee has the discretion to decide who out of the family gets the money. Now, this is not a favoritism type thing. This is for practical reasons and tax reasons. That in certain years, it might be good for the money from the investment to go to one person because their taxable income is down for the year. They might have taken a year off, therefore the taxable income is down. So receiving that investment, they're not going to pay much tax on it. Or it could come down to when the capital gains, the sale of an investment. So the timing can be organised to who the money goes to. So it's totally discretionary as to where and who and when this money is actually paid out. Got to be paid out within the financial year, but it really comes down to this business of being out who it goes to is the most important component of it, and that trustee's got the discretion there to decide how much of the income goes to who each year. Now that's different than a normal trust, like what they call a unit trust or a fixed trust, a bit like a super fund where you own a portion of that, or an investment like a managed fund. It might be a trust arrangement where you own certain number of units. Therefore, your payout is a percentage of the total number of units in the trust, and therefore your benefit is going to be a fixed percentage in a normal trust. But in a family trust, a discretionary trust, totally up to the trustee as to how much each person in the trust, the beneficiaries, are actually going to get. Different than a company, whereas a trust is not a separate legal entity, meaning that it's just an agreement between these parties, so it's not a separate entity from that point of view. And so this can be different, certainly can be cheaper in setting up a trust, generally speaking, than running a company from that point of view. And it just means that a trust has to abide by the agreement. And the agreement we talk about here is the trust deed. So there's a trust deed, and the trust deed spells out what the trust can do. And so this is where obviously having a pretty flexible trust deed can be useful. May not be necessary depending on who's in the trust and the number of people and so forth. So this is where talking to a good accountant who specialises in setting up trust could be the way to go, to work out what sort of deed do we actually need for that point of view. So inside the trust, there are a number of people, key people. We've got a trustee, the beneficiaries, the settler, and the appointer. So all pretty fancy names, but let's find out what they're all about. The trustee. Now, okay, this is the person who, in theory, is the legal owner of all the trusts, all the assets that are in this trust. And of course, the trust can hold, property. The trust can hold shares. It can hold anything that's of value can be part of the trust. But it's the trustee's responsibility. That's the person. He's legally responsible to the creditor. So if the trust has any sort of issues and debts and so forth, then the trustee is the person that is legally responsible for it. So sometimes these trusts can be set up where a company is actually the trustee. So it just means that you're setting up a company structure to be the trustee, and therefore The company is the person that is then, well, the person is the party that is now liable for any creditors. And this can actually create a little bit of a moat, a bit of protection for families and so forth if they've got a company trust. Obviously, it adds to the cost, and depending on your scenarios and what you're doing, may not be necessary. Generally speaking, would be necessary perhaps if you're running a business. There could be some sort of arrangement where you're running you might be a builder, you've got a family trust to distribute the money coming from the building company and so forth. Having that company structure as the trustee can give the family a bit of protection if things don't go quite according to plan. But the trustee has the authority to distribute the income and the capital gains to the nominated beneficiary. We're going to talk about this in the next session. We're talking about using a family trust. But this is the benefit, is the fact that the trustee can distribute the money to the beneficiaries whenever how they like. So the trustee is the person who's got the absolute discretion on how the money is going to be distributed. Now, obviously, pretty important role, and you need to choose that trustee, obviously, very, very well. The beneficiaries are obviously the people who are going to benefit, from this trust. So these are the people who are effectively going to, grab the money as these investments and so forth return the income or the capital gains and so forth. And so the beneficiary is just the people who are going to benefit from the money. And of course, they get this money, they get the trust income, they get the capital gains, so long as the trustee nominates them in the financial year. If the trustee doesn't nominate them in the financial year, they won't get anything. So it could be a case that one person in the trust gets everything in one year, another year might be equally distributed, or it could be a totally different person in another year. So it's unlike the trustee, even though these people are the beneficiaries have got absolutely no control. They can't say, oh, give me the money. No, that doesn't work like that. They are just the beneficiary. They're in the total hands of the trustee. Now, you can name the primary beneficiaries of your trust and also nominate unnamed beneficiaries. This is where it gets interesting, meaning that even though the beneficiaries are named, so we know that, it's your brother, your sister, the two children and whatever might be the beneficiaries. But the trust can, for example, at the bottom there, can nominate the spouse of John Smith. So if John Smith is one of the beneficiaries, the trustee could even nominate the spouse of John Smith to be entitled to receive the trust income. So pretty flexible, pretty powerful. So it's just, understanding what the trust can actually do. And that's, of course, spelled out in the trust deed. The settler, a bit of an unusual sort of role is the settler. He's only got a role in the setup. So they're just the person that is basically setting the trust up. To form a trust, the settler needs to give the assets, or a sum of money, of course, if it's just coming from a lump of money to set the trust up in the first place. But it could be just the assets could be coming across as shares or whatever it may be. The settler is the person who's actually signing the trust deed to set this this thing up. So the settler basically gives the money to the trustee to set up using the trust deed. Once the trust has been set up, the settler's got no more involvement. Normally, you get your accountant to do this. So the accountant is a person. It's one of those roles that you think, well, what's the purpose of it? Let the accountant handle it and get it done and dusted. Once it's up and running, we don't need to worry about a settler anymore. But an appointer, however, this is an important role, very important role, in the regard that the appointer is the person who wants to get it set up in the first place, in theory, but it could be anybody. It could be the trustee, it could be the beneficiary, it could be basically anyone involved in all of this. But the other person who effectively has now got the control over the trustee. They've got control over the trustee. So if the appointer believes that the trustee is not doing a good job, that they're not really, controlling the trust in a manner that they would like, and they're not distributing the money in an appropriate manner, then the appointer can indeed override it. So I think he can get rid of the trustee. So the appointer effectively has got the ultimate control, because even though the appointer is not involved in the day-to-day control of the assets, the appointer is the person who can get rid of the trustee, the guy that is looking after the investment. So if the appointer doesn't believe the guy's doing a good job, then literally they can indeed can be moved. Now, of course, it could be someone who is you might want to get a totally independent person. So you might have a professional such as an accountant to be the appointer, because they've got a better understanding about what the trustee is doing. And if the trustee is not doing the correct job, well, the accountant can say, well, hang about, why on earth didn't the trustee distribute that money to this person because of whatever reason? So pretty important role. And of course, having an independent appointer does mean that you're sort of lowering the risks of anyone sort of utilising the trust to their benefit at the expense of other people, other beneficiaries. So a few important roles there, and it can be simple once it's set up, can be complicated depending on the complexity of what you really are trying to achieve, and obviously the level of assets. Does it need that level of complexity? But the next session we're going to be doing about the use of a family trust. Some of this will become a little bit clearer, hopefully. I obviously suggest if you're going to set up a family trust, have a talk to your accountant, but of course we're more than happy to have a chat to you about these sort of things as well.